Hello, everyone. Thank you for joining us for a special event in regards to the New Hanover Regional Medical Center sale and some of the important changes that have happened inside of the benefit structure and specifically the retirement plans that are available to employees. There's been a lot of talk recently about what this sale will do for the county and the region of Wilmington. But there hasn't been a whole lot of talk about what that will do to the employees, one of the hospital's most important assets. So today we thought that we would shed some light on some of those changes, what they mean for employees, and what types of implications they may have for your retirement over the long run. First, I'll introduce myself. My name is Zachary. I'm a certified financial planner and wealth advisor with Pathfinder Wealth Consulting in Wilmington. We have served employees and leadership of the hospital for many, many years. And specific to some of these changes, we've built some tools to help test the changes to see, not just what the immediate impact will be for employees, but what does this look like over the long run, the next 5, 10, and 15 years. So one thing as part of any financial presentation is a disclaimer. So I do want to mention that this presentation has not been reviewed or endorsed by the hospital or Novant. This is based on our own independent analysis of the things that we have gathered so far. Some of this may change, and of course, the actual results may vary based on your individual situation. So this is really meant for educational purposes to give you an idea of what this kind of looks like. Overall, aside from the political noise around this, looking at it from a employee perspective, this sheds a little bit more light on how this is going to actually affect the employees of the hospital itself. So overall, there's some benefits for the community that with the foundation that will come of this. But for the purposes of today, with this merger of the county-owned hospital to a privately owned hospital through Novant, we're looking at what kind of impact this is going to have on the employees in particular. So, in summary, the main thing that we do know, that's one of the largest changes and most notable changes with the new benefit structure is a freeze of the pension plan. So, there's been in the private sector, pension plans are largely a thing of the past, and in most cases have been replaced by what's looking to be happening here, replaced with a match on the retirement savings plan. So the 403B plan, which as an employee you've always had access to a 403B, going forward there's going to be a contribution from Novant going into the 403B in lieu of a pension plan. So between these two types of benefit structures, there's a lot of differences. The pension plans are considered defined benefit plans because the benefit is defined at the end. So there's a formula that determines what your benefit's going to be at the end. So we'll talk about some of the specifics there versus the 403B plan, which is considered a defined contribution plan. So the benefit to you is defined by contributions on the front end, not an end benefit. So it's harder to see what the benefit's going to be at the end because it's based on a lot of factors, including investment returns, contribution rates, and that sort of thing. So not necessarily a good thing, not necessarily a bad thing. It's just different, and we'll talk about some of those differences and what the effects that they might have on your situation. So first, let's look at the pension formula. Now, the old pension formula with the pension plan that's been frozen. So first, there's really three main factors that go into the pension formula. First is your credited years of service, CYOS. So this is calendar years of service with at least 1,000 hours of service. The next one is your final average compensation. So it's the average of the highest 5 consecutive years of pay over the past 10 years. And then finally, covered compensation, which is an average of the Social Security wage basis for the 35-year period prior to your Social Security full retirement age. That third one there's a table that the government posts every year that has those numbers in it. So the first two are based on your actual employee record with the hospital. The third one there is based on a government table. I will note some things. It has been communicated that there will be some credited years of service added on to the employees' records, which will help boost what the pension benefit will be. Even though going forward, now that it's frozen, there will be no additional years of service accumulated for hours worked with the new structure. Now, to give you an idea of what those formulas look like, there are two different formulas based on when you join the hospital. So for those hired prior to January 1st, 2001, you actually got a little bit higher percentage of your FAC, your final average compensation, built into the formula. So for those hired prior to 2001, it was 1.25% of your final average compensation times your years of service up to 30 years. For those after 2001, it's a little bit lower than that, 0.75% of your FAC, again, times the credited years of service. So it's either or of those two formulas based on your hire date. And then next, they add a 0.65% of your FAC in excess of that covered compensation. And I'll give you some examples of this. We're going to run through a case study next to show you what that would look like. But that gives you, really for the folks that are above that Social Security wage-based average, they get a little bit extra boost in their pension benefit. All right, so let's go through a case study. So we've got a hypothetical individual here, Sam. Sam is 65 years old. He was born in 1956. He was hired in 2006, so he was hired after that 2001 change in the formula. In this case, we're going to assume that his starting income in 2006 was $80,000 per year, and that he's gotten a 2% bump in his pay for each year thereafter. So here's the numbers if we run this out to Sam's age 65. So at age 65, he'll have 15 years of service. His final average compensation, again the highest consecutive 5 years, comes out to $103,529, and then his covered compensation per that table that we get from the government is $93,564. So you can see here the breakdown. So we take that through the actual formula, the 0.75% times the FAC, and then we multiply that by the 15 years of service. So that gets us to the first annual benefit amount. And then next we take the difference between the average compensation and that covered compensation from the Social Security wage base, and then we multiply that by that 0.65% extra factor, and then we go and multiply that again by the 15 years of credited service. So there we get a number 972. We add those two numbers together and that gets us to what Sam's age 65 benefit will be, or $12,619 per year, or on a monthly basis, $1,052 per month. So those are now based on these numbers that we've just looked at. That's the guaranteed lifetime income amount that Sam can get. So if Sam retires at 65, he starts that income amount. No matter how long he lives, that he's going to continue to get that amount of income. So again, what that means is Sam can take the annuity benefit and get that $1,052 per month for the rest of his life. And then also, if he has a spouse, he can add survivorship protection. So what that does, let's say Sam's married and he wants 100% of that benefit amount to continue to his spouse if he were to decease the spouse. What this does is reduces the monthly income amount that he's eligible based off his lifetime, because it continues that income amount. So it depends on a few factors, like the life expectancy of the spouse, to determine how much of that reduction is. So that's definitely something to consider for folks that are taking pensions. Do we have a survivor that we would want to protect Otherwise, if Sam starts this benefit and he passes away in 5 years, that money is no longer going to pay out to his family. So, very important consideration. As part of that, Sam is also eligible to take a lump sum of his pension value, of his accrued pension value. So let's look at that for a second. So what that does essentially, as you can guess there, by getting a lump sum of that amount, Sam now has full control over the cash value of the pension. So he would likely want to roll this to an IRA or a retirement account. Otherwise, it would all be one big taxable event. So that pension income is taxable just like your regular earnings are. So you want to roll that over to an IRA or a retirement account, but then you have full flexibility. You lose that guaranteed income payment, so there's not going to be a payment that you'll continue to get for the rest of your life, but you get full access to it. So there's pros and cons of those two different scenarios. We'll talk a little bit more about that. Based on your results will vary based on your individual situation, though the choice that's right for you is going to vary based on your financial situation as well. So how do they calculate this lump sum benefit? The lump sum benefit amount is based on the present value of the pension annuity payments. This is one thing that inside of the pension plan documents, the summary plan description, there's not a clear method that they use for calculating this present value. Typically, there's a interest rate associated with it, we call it a discount rate, to get to this lump sum. So what we did was looked at a few different pension estimates that we have from clients, and got that discount rate that they've been using to get to this lump sum. So by running that calculation to get the present value, the value of those monthly payments, the $1,052 per month for Sam's lifetime, would be $118,000 in cash value. So that $118,000, Sam could take that, put it into an IRA. And that's the current value or the present value at age 65 of the pension. So that gives us a few different things to be able now to go and compare with that 6% 403B match. Okay, so when we run the numbers out, so the way that we do this is we run Sam's income. Now again, this is starting when he was hired in 2006. And we run this out based on that 2% income increase. So every year his income goes up a little bit with his wage increase, and that 6% match goes up a little bit. So basically the way we're looking at this is if we take that 6% match from Novant and we set that into the 403B, what's that going to look like? What's that potentially able to grow to by the time Sam is age 65? So we run a few different scenarios based on different growth rates, and that's one of the key differentiators between the pension plan and the 403B right here. And that's because a lot of the potential benefit that's available inside of the 403B is based on assumed investment returns. So we could look at historical data to see what a basket of investments has done, but that is largely variable. There's no guarantee that that's going to repeat in the future. So in our industry, we always say past performance is no guarantee of future results, and this also applies to that saying. Let's look at that over a few different rates. Now, if you just were to take that money, say the money market fund in the 403B is paying 0%. So if you were to stash all that match money into zero yielding fund inside of the 403B, you'd accumulate $89,469 over that period, over that 15-year period. You'll notice that's quite a bit less than the $118,000 that we saw on the prior slide for the present value of the pension. So that's not going to cut it. So if someone were to just get that match and stick it into a no yielding fund, then the 403B is not going to be a match for the pension plan. Once we start to increase those rates, so then we start to increase those rates of returns, you'll see there we ran a 4% rate of return, which brought us to $124,849. That gets us above already the present value of the lump sum pension. And then we run 6%, which you get $148,000, and then 8% in investment returns. and that brings us up to $177,000. So as you can see there, the as long as someone could earn at least 4%, the 403B match looks like a favorable alternative to the pension plan. So next we took it a step further and solved for the break even. So what is the exact rate of return that someone would need to earn to be able to beat the cash value of the pension? That number is 3.34% based on these inputs. Now we did run a few different salary ranges, and that number is going to vary on based on your situation. So that's definitely something to keep in mind. Is that it can vary based on your income history and your service record. But in all of the scenarios we ran, a typical investment portfolio has the ability to beat the potential benefit of the pension plan. But what this does mean is that the risk of investing those monies is now on the backs of the employees, versus with the pension plan, the hospital was in charge of investing that money in the pension plan to meet that future defined benefit. Whereas here, it's a flip-flop to where now it's all on the based on the investment strategy that the employee is employing inside the 403B. So there's going to have to be a closer attention for employees on investing their pension funds, their 403B funds rather, to make sure that this is going to be a good equivalent. So for the most conservative person who's going to keep their money in the money market fund, this is not going to be a good replacement. Whereas the person that is willing to take a little bit more risk with the money and put in some more aggressive investments like stocks, if the history repeats itself, those returns are likely going to be enough to make up for the loss of the pension plan. So here's a few other things that we know. We're not sure of the specifics just yet on some of these topics. But number one, you should have the ability to roll your existing 403B with AIG, and also the 457B plan, into either an IRA that you have outside or into the Novant 403B plan, or you could potentially leave it as is. As far as we know, there's not going to be a force out with the AIG plan. At a certain point, you could keep it there invested, or can roll it over to another place. I've heard some things of potentially moving the plan from AIG to Fidelity, but they might do that perhaps next year. But that is all to be ironed out. We have heard that there's going to be a 457B plan. I haven't spoke much about that yet, but right now, or previously, there was the 403B plan and a 457B plan, and employees could opt to participate in both, which is really fantastic way to sock a lot of money away for retirement. The 403B, you could put up to $19,500 in each year. If you're over age 50, you can actually put in an extra $6,500, so $26,000 that you could put into a 403B. With a 457B plan, you could do that again. So you could put in another $26,000 if you're over 50, or the $19,500 if you're under age 50. So just a tremendous ability to put more money away, and all of that goes in pre-tax, so it reduces your taxable income today. So it was good to see that 457 plan is going to be available. The specifics we're not sure yet, but it will be good to see that is an option going forward for employees. So again, you'll have the option to take a lump sum of your accrued benefit now with the pension, or you could leave it in the plan and take it at a later date. So that's an important one, and I've seen a few statements already come in of what the lump sum value is now if you were to take it versus what the lump sum value would be at a later date, at age 65 for the full benefit, or you could take some reduced benefits at earlier ages as well. So that will be an important consideration to try to figure out not just whether it's lump sum or monthly income, but also do you take that lump sum now or do you wait and take it at a later date. So I will say that the pension plan has a quite a good payout rate. It's got quite a good credit rate. So if you for example, if you were to leave it in the plan and wait till age 65, those annual credits that they give you for delaying that are pretty good. And then also the pension plan is in good shape. So we've had a lot of questions about that. That with this change, is there any risk of losing any of the pension funds? And not any more risk than there was before. So this pension fund's managed by a third party. Novant doesn't have any control over that. So and it's required to be funded. There's annual funding analysis that happen every year to make sure. And Novant has actually even put in some money into the pension plan to make sure that it's adequately funded. So it is in good shape. So there's not a lot of concern there from us for the long-term feasibility of the pension plan to be able to meet those pension obligations. Of course, that could change, but right now that looks pretty good. One thing that we did confirm too that I just mentioned is being a county-owned hospital, there's an organization called the PBGC, Pension Benefit Guarantee Corporation, that guarantees pension benefits. So if a company were to go bankrupt and not be able to pay the pension obligations, the PBGC could jump in and help guarantee some of those payments. The hospital plan did not have the PBGC coverage. It wasn't required to, being county owned. So that is a little bit of a risk that there's not that protection on the plan. But again, right now the plan's adequately funded, so we don't see that as a big concern. Next, I've already mentioned this one. So the pension eligible staff will get extra years of service based on their income, age, and years of service. So you'll get some extra credits going into the pension formula, which will help to offset that change from the loss of the pension plan going into the 403B now. I'll talk about what those numbers look like on the next slide. Most employees already received this, is a transition award for all active payroll employees. They'll get a certain amount of a transition award from Novant once the deal has been done, which it already is. So a lot of folks have already gotten that. And then also active employees will receive a $500 retention bonus every year for up to 10 years as part of the deal as well. So some neat benefits that existing employees will get to take advantage of. Here's the pension credit program. Again, based on income, based on age, and based on service years, you're able to get up to 8 years of additional credited years of service added on to your pension into your pension formula. So a fantastic benefit that's added on there to be able to boost your potential pension benefit. And that would go into whether it's the lump sum or the monthly annuity. That's going to be factored into how your pension benefit is calculated. And here's the transition awards based on your FTEs, or your full-time equivalents. So depending on what your pay status is and working status, you can get up to $5,000 gross in a transition award. So that one's pretty neat as well. All right, so let's go back over what your options are as part of this sale of the hospital. So with the pension plan, again, you can either take it as a lump sum withdrawal with the cash value now, or you could leave it in the county plan, take a lump sum in the future, or that monthly annuity in the future. So there's lots of flexibility there. Again, it depends on your situation, which is right for you. Most people, if you're still working, it makes sense to leave it in there and let it continue to accumulate those interest credits over time. But then when you get to that period where now you get to that full benefit and you're getting ready to enter retirement, then when it's a good idea to sit down and look at the lump sum versus the monthly payment and which one's going to be the most bang for your buck based on your health situation, your family longevity, your other assets that you have for retirement, and all of those little factors that come into play. All right, then for the retirement savings plan, with the 403B and the 457B plans, again, here's your three options. You could roll them into the new plan with Novant, roll them to an outside IRA, or you could leave them as is. And to talk about some of the pros and cons of each one of these, again, I've hit some of these quickly already. The pension plan is going to provide guaranteed income for your lifetime that you cannot outlive. Lifetimes because you could add that survivorship protection. One potential negative of the pension plan is that it does not provide inflation increases. So your Social Security income that you'll get hopefully in the future has a cost of living adjustment each year. The pension plan does not. So that's important when you look at that lump sum versus monthly annuity payment. Making sure that you're covered with inflation, since the pension plan will not cover that. The pension plan has a high payout rate, so that's a plus for the plan. That we look at that by taking your monthly income amount over what you could potentially take in the lump sum. In other words, how much your lump sum would have to generate each year to meet the same level of income. So it is very high from the get-go. That rate starts to drop because of the lack of inflation protection over the long run. But starting out, it is a very good payout rate. And then finally, as I mentioned before, the county pension plan now is not covered by the PBGC. So you don't have that protection if for some reason if the plan fund went bankrupt. IRAs, so this is going to apply to really a lot of these are going to apply to the pension, looking at the pension roll into an IRA, and also the 403B roll into an IRA. So an IRA gives you some flexibility. The first big difference is that you have a lot more investment options. You could include individual stocks, for example, in an IRA, which you can't do in a 403B, or certainly not in the pension plan. It gives you more control and more easier access for withdrawal strategies. So an IRA, with the pension plan, for example, once you start that income, basically you're guaranteeing that you're going to get taxed on that same amount of money every year. Versus an IRA, you can strategize and say, based on other income for a given year, I could take a certain amount out, and you a little bit more control over what your taxable income is for the year. An IRA does give you more control over costs as well. Not to say that IRA is cheaper or more expensive than leaving it in the pension plan or a 403B, but it gives you more control. So you could hire professional management. So if you have a firm like Pathfinder manage those assets for you through retirement, that you have that ability. Whereas 403B and pension plans are just not built to be actively managed like that. So you have that flexibility. Over with an IRA versus with the 403B or the pension plan. Now just looking at some of the benefits of the 403B. So looking at rolling it to a 403B or maybe to the Novant plan, that could provide some greater simplification by having all that money in one place. So rather than leaving it out in AIG, for example, with the 403B plan there, if you roll that into the Novant plan, you've got it all in one pot. You can control the investments all in one spot. It just makes it a little more simpler to do that and streamline the investment management part of it. One benefit of the 403B as well is that if you plan to work past age 72, you can actually delay required minimum distributions until you stop working. So the required minimum distributions are required once you start 72 with an IRA. And that's basically the IRS saying, you've had this money protected from taxes for this long. We're going to now start to need some of that tax money back. So Uncle Sam's going to make sure they get a certain amount every year to be able to get some of that tax money out, so you don't just leave it in the IRA for forever and never pull it back out and get taxed on it. So the way that it works out is that by age 113 or 113, if you made it that long, you'd actually pull all of the money out of the IRA, and all that tax money would go to the IRS. One more complicated strategy that we use is something called a backdoor Roth IRA strategy. And if you have other outside IRAs, it prohibits you from being able to do that strategy. So if you were to roll all of your IRAs to a 403B, you have the ability to then make those backdoor Roth IRA contributions. Those rules and guidelines have changed quite a bit over the years. So there's some very kind of strict ways that you have to do it to be in adherence with the latest IRS guidelines. So it's important that if you're doing those, to make sure you look at it and do it the right way. But again, by having an outside IRA, whether you roll the pension money out to an IRA or the 403B out to an IRA, that basically prohibits you from being able to do backdoor Roth IRA contributions if they make sense for you. So anywho, so that's kind of a breakdown of the pros and cons. Again, I'll say it again. A lot of these things have to do with your individual situation. So at Pathfinder, we're big about looking at someone's situation, understanding what they're doing, what they're trying to do with their life, and then building a plan to match. So one thing that we recommend for one person could be totally different for another. So there's not especially with something like this, there's a lot of factors that go into a given recommendation on what to do. So again, we built some tools to help test these scenarios to see how they're going to benefit your plan. If you have any questions about that or what we do here at Pathfinder, give us a call. All of our contact information is there on the screen, and we would love to sit down and talk and see how we might be able to help. Thanks for listening.